Oil settling at three-month highs at just over $120 a barrel. It comes as Shanghai ends its two-month COVID lockdown, opening the door for higher demand and more upside for prices. But it didn't spook Wall Street. Stocks up across the board, and our next guest believes the market can handle another leg higher in energy prices and could reclaim 2022 highs. Marko Kolanovic is a chief global market strategist and co-head of global research at JPMorgan. He joins us on the Fast Line. Marko, welcome back to Fast Money.
Thank you, Melissa. Good to be back.
So you like energy still, it's your top trade, and you think oil can go to 150 and it wouldn't be a problem?
So we published a few months back that we think consumer can handle oil 130, 135, because we had that back in 2010 to 2014. So inflation adjusted, that was basically the level. So we think consumer can handle that. Now, we do think there could be some potential further spikes in oil, especially given what we have a situation in Europe and a war. So we wouldn't be surprised. But it could be a short-lived spike and eventually sort of normalize. However, energy stocks are still our top call. They are still attractive. Actually, valuations went lower despite the stock price appreciation. Earnings grow faster, so multiple is actually lower now in energy than it was a year ago.
When you think about what the consumer can handle, Marko, I mean, it's one thing to say the consumer can handle $150 barrel in oil and all the corollaries off of that in terms of gas prices and you know, keeping your house cool over the summer, et cetera. But when you're seeing that rise in conjunction with higher energy price, higher food prices, excuse me, higher rates, et cetera, what is the breaking point of the consumer? I mean, it sounds like you think the consumer will keep spending pretty strongly and it wouldn't hurt the economy.
Well, the question, Melissa, is how long that condition can stay. You know, we do think that sometimes in the second half of the year, situation in Europe, geopolitical problems in Europe could ease a little bit. So the question is for how long? You know, so not 150 oil for sure, not for indefinitely. Consumer would buckle at some point. But we think short-term spikes can be handled. Even this level on a more sustained basis, I think consumer could handle. Of course, consumer spending pattern would change. You know, so there would be some losers and some energy we think would be a winner of that, you know. So certainly would be also a little bit of reshuffle that would not be entirely painless for the other segments.
Hey, Marko, it's Tim. One of the things I think has been most impressive about your market calls over the years is you've been very balanced and reasonable during periods of hysteria. One of the things you're saying in the second half of the year is that there's going to be a gradual market recovery, possibly a Fed pause, but much lower volatility. And with that, again, some market factors that would be spurring on vol-sensitive investors back into the market. Talk about that, because I think that's critical.
Sure. Thank you, Tim. So, yes, basically in the first half of the year, especially first 4 or 5 months, we saw very high volatility, not just in equities. There was very, very high volatility in rates, in bond space. Also, there was, unfortunately, this negative correlation of bonds and rates, equities and rates, you know, which have further made the problem worse. You know, as a result, investors have been de-risking pretty steadily in the first 5 months of the year. So right now, we estimate that, for instance, positioning of these investors, such as Volt Targeters, Risperity, insurance companies, gone down basically to the bottom, to the, call it, 5th percentile. So now what we expect is that volatility normalizes a little bit. So VIX kind of in a low to mid-20s, and that over time pulls inflows. So these investors, they back exposure and they buy equities, and we think that these flows could be around $500 billion if volatility can sort of stay where it's now and go a little bit lower, you know, so call it VIX in low to mid-20s, you know. So we expect that, and we think that's a part of our thesis why we think market can recover, you know. So positioning is very, very low.
Your top picks, Marko, energy, small caps, and high beta tech, and you don't see any recession coming. And so I'm wondering what you think of prognostications made by some key figures on Wall Street of hurricanes that could be the size of Superstorm Sandy. And I'm talking about, of course, your boss, Jamie Dimon.
So look, everybody's kind of looking for all possibilities, and one wants to be ready for all possibilities. But our research view is that base case is that there is no recession. So we do forecast some slowdown. So of course nobody's saying that there are no problems, but we think that the U.S. economy and global economy will stay out of the recession. You know, and as such, we don't think investors will sit in cash for the next 12 months. You know, waiting for this recession. So I think at some point, as you, Melissa, mentioned, if the Fed can give some indication, if we continue to see consumer, especially on the services side, holding up, which we do expect, then we think investors will gradually come back into equity markets.
Marko, it's always great to speak with you. Thank you.
Thank you so much.
Marko Kolanovic, JPMorgan. Okay. What do you think, Dan?
Well, I'm glad you brought that up because, I mean, listen, obviously Jamie Dimon's one of the most followed, bankers on the planet, and he has lots of data. He's seeing lots of different things, and he doesn't run a research shop individually. He's probably speaking from, the hip a little bit, but then that was followed by Elon Musk, who's the CEO of a company that makes electric cars, that has a $700 billion market cap, who says he is super worried or something like that about the economy. I mean, you have to piece this stuff together, and you have to think about who has a lot to lose by not being out there and saying such things. And I think those guys certainly do. And I think that you probably want to pay more attention to those sorts of warnings.
Elon's never said anything extraordinary.
Well, I mean, but you know what? I'm not a fan of his, but what I'm saying is that was a pretty significant comment. I'm surprised it didn't come with an SEC filing.
I mean, if Mary Barra said it, we'd have a different reaction. Right? As opposed to Elon Musk. And I mean, granted, they're very different kinds of figures and they speak in very different manners. But in terms of the head of a major automaker in the United States, if somebody said really bad feeling about the economy, you would probably get more attention than what Elon Musk, saw.
I think that's absolutely fair. She didn't say it, but it's just, to me, it's just a matter. Listen, you can't discount Jamie Dimon when he says something like that. He obviously chooses his words extraordinarily carefully. He knows what he's saying. He knows the ramifications behind of some of the things he said. Elon Musk probably not so much. I'll take Jamie at his word. Now, again, what category doesn't matter, but I still think there's pain ahead. And we talked about energy. Energy's not going lower anytime soon, by the way.
Let's be clear. I mean, because when he had his investor day, that's not the story he told. When he was talking about what kind of risk they will take, he was being conservative. He was saying, we're going to service our existing customers. We're not necessarily going to go out and take unnecessary risk because of things that could happen.